following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we want to let our listeners know about the newest U.S. options exchange. Launched in August, it's ISE Gemini, the ISE's second exchange, which brings the total number of U.S. option exchanges to 12. For those of you who don't know, the original ISE was the first electronics option exchange, started in 2000. ISE and ISE Gemini are part of Eurex Group, owned by Deutsche Börse. Well, that's the latest for industry happenings. Thanks for joining us.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
I'd like to welcome Geralyn and Endo to today's Profiles and Perspectives. Geralyn, great to have you here.
Thanks for having me. Great to be here.
It's nice of you to take your time to join us and help our listeners get to know much more about the wonderful ISE. But before we talk about the ISE, how about if we talk a little bit about yourself? How did you get into the industry, and how did you land up at the ISE?
My background actually was in the technology side. I was a software quality assurance engineer at a Wall Street firm. And then
that sounds pretty technical.
Very technical, absolutely. And I transitioned over to the exchange business. In July of 2004, there was an opportunity at ISE, and what was so alluring about ISE was the fact that it was the first fully electronic options exchange. So having a technical background to come to a company that's technology is the forefront of the business was extremely appealing to me. So I started out at ISE testing our core exchange, the actual technology platform for the exchange, as well as our front-end Precise Trade, which is our internally developed trading application. I became a subject matter expert of the exchange itself, the business rules and the technology that ran the exchange. And after 3 years of being in the QA department, I transitioned over to the business side. The technical background provided
the necessary, background to wear so many hats?
To wear so many hats
at
and
the
to
ISE.
And to help our members and have the conversation with our members, given it's a technology, we're an exchange, but it's a technology firm. The technology background enabled me to, or still enables me to really help our members and understand our members' needs and translate that back to enhancements for ISE.
That's really fantastic. I had no idea you had such a varied background. Good for you. Mm-hmm. Now, you mentioned you joined ISE in 2004. Mm-hmm. The ISE was founded, I believe, in 2000,
That's
right?
That's exactly right, yeah.
Tell us a little bit about, how it started and maybe, the transition through 2000, 2010, 12 at the time.
Sure, I've seen ISE evolve tremendously over the years in my 9 years there. From the new trading functionality, new products, a brand new trading platform we launched a couple of years ago. We launched our front end, as I mentioned, Precise Trade, which is extremely well received, and it's referred to, and I may be a little bit biased here, but everybody says that it's the most user-friendly trading application that's out there. We've also gone through an IPO, which was a great experience because we were the first publicly traded exchange. In 2007, we were acquired by Deutsche Börse, and the great part about being a part of such a big company, but we still have that small company feel, which is what keeps me at ISE, the culture and the people. Even though we are a part of a much larger entity, ISE itself maintains that entrepreneurial spirit and great culture that's great to go into work every day.
Well, tell me a little bit about the team that you work with at ISE, because my understanding is you get a lot done with not too many people.
Yes, we run lean and mean, as we like to say.
Yes.
Absolutely.
So tell me about some of your colleagues and the different things that you do.
I'm actually the Director of Business Development. I work with Janine Hightower and Boris Ieski, and I have a team of relationship managers. Basically, as the business development team, we are the ambassadors of the exchange. So we are out, we are facing all of our customers on a daily basis, whether it's in person or over the phone, in constant contact with our members to make sure that they're educated about our products and services. But a big part of our role is also to understand our customer needs and wants and translate them back to the ISE as we introduce new technology or new products and services or change our fee model and things like that.
And those things are happening all the time at the various exchanges. I mean, it's such a dynamic, competitive environment. It's really something. Do you have a typical customer at the ISE, or are your customers the wide range, institutional, retail, all kinds of different customers? All kinds of different customers.
The majority of the people that we deal with on a regular basis are broker-dealers, so we don't have a tremendous amount of contact with the retail side of the business, but we do recognize that the retail folks are actual end customers, so a lot of what we do is targeted at their needs and wants, yes.
Well, the transparency of the listed business, the speed of execution. Oftentimes when we're out giving presentations to retail audiences in particular, we try to emphasize that, it's never been a better time with commission fee levels. It's just a great time for the retail investor to access the options market.
It certainly couldn't be easier for an individual investor to access the options markets today. Yes, absolutely.
And I think that sometimes that's lost on investors. I'm not sure quite why, but having been a long-time floor guy myself, I know how difficult it used to be, even as a professional, sometimes to get executions. And, it's a whole different world now.
Absolutely. And that's what ISE did. We revolutionized the industry by being the first fully electronic exchange, where historically or back in the day, someone had to pick up the phone to call their broker. The broker had to call the floor to get the order in. The order was placed. The order would be executed, and then that chain would flow backwards. So you can imagine how long that would take. And today you can be filled with a simple click of a button and be done.
Indeed, you can. Well, I don't think it's a coincidence that option volume after the ISE started, has just grown, exponentially, from, I guess 550 million in 99 to, what did we do? A little over 4 billion last year and 4.6 in 2011. So, A lot of that is, I think, attributed to, as you say, the electronic access that ISE first provided for the industry.
Absolutely, and we continue to focus on simply growing the pie in general as an industry.
I see that, in the next couple months, you're going to bring another exchange to the floor, and I guess that will take the industry to 12, listed option exchanges. If you would, tell our listeners about the motivation for that and, why another exchange.
Sure. So we're going to be launching ISE Gemini. The motivation there is we have a great proven technology that we're going to leverage, essentially kind of a copy and paste, and introduce the same market model, which is our patented customer priority pro rata allocation, same technology platform, same people, but offer a different fee model to our customers.
Okay, so it's that fee model that's going to be really the instrumental change with the new exchange.
Absolutely.
Okay, good. Are there any new product initiatives that you'd like to discuss that the ISE has, or?
Certainly, we have the industry-leading complex order book, and we continue to innovate in the world of complex orders. Last year, for example, we introduced implied orders, which dramatically increased the fill rate on complex orders, as well as tightened the ISE BBO. And we're going to continue to enhance that functionality that will further increase the fill rates. We've got other complex order enhancements coming for buy rights and delta neutrals, for example, as well as providing NBBO protection for customer spreads. A
couple things for some of our listeners who may be a little bit new to the option space. NBBO. What's NBBO?
Sorry about that.
That's all right.
National Best Bid Offer. So, meaning there are 11 exchanges all posting bids and offers, and what's displayed is actually protected. So when a customer enters an order on the ISE, for example, or on another exchange, and an away exchange has a better bidder offer, those bids and offers, those prices are protected. So that customer order will actually end up linking away to another exchange. Now, historically, in the complex world, that protection doesn't exist as to the extent that it does on a single-legged order or a simple order. So we're going to introduce that. We're going to expand that protection to complex orders.
And again, for our newer listeners, that whole idea of a complex order book. Why don't you break down exactly what that is?
Sure. A complex order book is essentially any option strategy that has more than one option series in a single package.
Okay, so a multi-leg.
A multi-leg order, and you could certainly accomplish something similar by sending in two separate orders. Buying a call and a put, for example. But if you send it as a package, there are certain benefits from either pricing or protection, so you don't get legged in. You know exactly what you're going to get as a package.
Great, Geralyn. Well, we've probably covered, the ISE pretty well here. Before we wrap it up, do you have a story or maybe you'd like to offer our listeners?
Sure, an entertaining story.
Yeah, entertaining is always good.
After 9 years in the options industry, I certainly have plenty of entertaining stories, but let's just say what happens in Vegas stays in Vegas.
And on that note, it will stay in Vegas. So, Geralyn, really thanks for taking the time and allowing our listeners to learn about the ISE.
Thanks for having me again.
You're welcome. Bye-bye.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Al Brinkman of Brinkman LLC. Al, great to have you here today.
Joe, thank you very much. Pleasure to be here.
Why don't we just start? We go back a long, long ways, which is a great thing. And why don't you tell our listeners a little bit about some of your experiences in this great industry?
Well, it has been a great industry and actually been very good to me because I actually started in this. I started on the Philadelphia Exchange in 1971 and options started trading down there in 1975. And as the story goes, I never looked back. Have been in the options industry my entire career for all those years, excuse me, and have watched it just explode into what it has become today, a mainstream investment vehicle for the people.
Now you're talking.
Absolutely. And I've been fortunate enough to be able to participate in a lot of the education both that the PHLX did on options and, of course, with the Options Industry Council. And I still continue to do that, doing some seminars for the OIC now and again.
Indeed, yeah, more than now than again. I think you got a pretty full schedule around this country.
Yeah, it's really exciting, and it's always good to see. What has been exciting the last year or so in doing these seminars has been new people entering the arena. We're getting a lot of people that they're just looking at using an option. So that tells me very clearly that there's still an incredible growth opportunity in the industry and people learning about the value of using options to manage part of their portfolio.
I completely agree with you. What do you think is bringing these people to the table of options?
I think there's a couple of things today. One is the risk management option, of options, being able to do something in their portfolio to protect against some of the sudden sharp movements that we've had. I also think the other issue is income-based strategies, whereas yield today is very difficult to come by, and you can use in a limited risk scenario using options to move up your yield in your portfolio.
Yeah, well, and additionally, we've got this whole idea of incredibly quick executions and transparency. You mentioned 1971, 1975, both great years. Why don't we go through how an order, we go back to those days as floor brokers on the floor.
Right.
Let's talk about how an order used to get executed. Go.
Used to get executed. Back then, of course, everything came in telephonically from the brokerage house to the floor. And options were traded specifically on specific exchanges at that time, meaning PHLX had a group it traded, the CBOE had a group it traded, and so on. But they all came in telephonically. There would be a trading desk at the firm that was the central location that would gather the option orders coming from the brokers in the branch offices, and then they would forward them to the floor. We would have clerks as floor brokers who would write down the option orders, and then they would deliver them through runners to the brokers on the floor located around the floor. And we would execute it, and then it would go back through that same process. So I think you can see right off the top that was a lengthy process at that time. The thing to keep in mind is the volume levels, although we thought they were very high, and we spent a lot of times in our crowds and a long time in a day standing in the same position on the floor trading a particularly active option, the volumes had no comparison to what we have today.
So, and also, the number of products and strike prices.
Absolutely. And Joe makes a good point. The number of products, obviously, ETFs were a thing in the future at that point in time. And
so we're
and
puts.
All the variations. And puts for a while, absolutely. And that was probably one of our most confusing things. And when I teach, I still stop for a minute with puts and make sure I'm doing the right thing and make sure that my students understand that they have to stop and think about puts because they are somewhat counterintuitive, I call them. But when they hit the floor and we were new, we were just barely getting used to the idea of call options. They had introduced the puts, and we were actually kind of baffled for a while on how to deal with those.
That's understandable, as we all were. It takes time for some of these concepts to sink in. Well, that's a little bit of the background, and I think back to the time of execution, it was not unreasonable that it was many, many minutes.
Many minutes, absolutely.
On a good day. And now it's just, microseconds, I think.
Yeah, almost nanoseconds at this point in time. And just to take that a step further, the industry couldn't have grown to the levels that it has today without this advent of electronic execution, order entry execution, and the solid educational resources thrown into it by operations like the OIC, by the exchanges, and clearly by the brokerage firms, getting people comfortable with using options. And it's one of those things, if you take it in its broadest context, obviously the advent of electronic trading was a major part of it, but other things were occurring at the same time that brought it all together. The advent of the internet and the information available on the internet so that you and I could do our own research and make our own decisions on underlying securities that we wanted to trade and do options on and that sort of thing. So there's a lot of parts of the puzzle that all started to come together, I guess, in the late 70s. Obviously, the advent of the ISE with electronic trading.
Late 90s, very late 90s, 2000.
Was a pivotal point.
And we also, at that point, had the dual listing.
Right.
Which remarkably for all those, a couple decades, you had to go to one exchange.
Right.
And as you say, a lot of that stuff all happened at the same time, and the business just has, exploded ever since.
And the competition between exchanges with the dual listing all benefited the individual investor because price points moved closer together. Everybody was looking to get that business to their exchange, so they were doing extra things to get it there, including education, as I mentioned before.
Well, this is our strategy spotlight segment. So good stuff about your background, some of the exchange history. Let's get into the topic that you'd like to discuss, and that's straddles and strangles. Why'd you pick these strategies?
Well, I picked them primarily because I personally have enjoyed trading them in most cases. I think it's a reasonably easy to understand structure, and the risk-reward profile is pretty easy to take a look at and understand very quickly. And
easy is good.
Yeah, easy is always good. And it's a volatility play. It's in an active type of situation in the marketplace. And
why don't we start, for those listeners who may be just getting started in options, clearly define what a straddle and strangle are.
Okay. Really very quickly, the long straddle, we're going to stay on the long side of the trade here today, is you're buying one call and buying one put on the same underlying security with the same strike price, and you're usually buying it an at-the-money option, call and put in this case, and of course in the same expiration month. The straddle varies slightly. What you're doing there, you're also long a call and a put. Now the call, you're going to move up a strike price usually from the at-the-money. It's going to have the higher strike price. And the put, you maybe move down one. So you're spreading your strike prices out from the at-the-money, usually just one strike price away from it.
And that's the strangle.
And that's the strangle part of it, so the straddle and strangle.
So if you're buying the at-the-moneys in the straddle, it's going to cost you more than the strangle. Because in the strangle, you're talking out of the monies.
Because the at-the-monies, pricing is going to do that way. And as I said, that leads to, in the straddle, clearly your cost of entry into the position is going to be higher. But by using at-the-money options, the break-even points for the trade are a little bit closer together. When you use the strangle, moving it out, your cost basis is going to be less, which you could then swing into a little bit of leverage there because you're paying less, so you might be able to do more with the same investment of the strategies. But by moving those strike prices further out, you've now moved your break-even points out on the strategy, so that changes the risk-reward profile. So.
Okay. You talked about we're going to analyze these strategies from the long side. What if you were talking, what if you're talking about the short side?
Well, you can do both of these on the short side, and there's some concern there. And once you short naked options, you're incurring incredible risk. You're putting yourself at a serious risk level there. You'll certainly need your broker to approve those for you. And if you're just starting, or even if you're in the middle of your options trading career, getting the approval for these strategies and then meeting the margin requirements and other requirements that they might put on might prove a little bit onerous for you. So we don't usually go that side. I know that there's been talk, a lot of people do that. They sell these, but it is a risky strategy, and you need to know that and be very aware of it going in.
Yeah, and I mean, really, you talk about risky. What's so important is that the risk really is oftentimes not quantifiable.
Right.
As opposed to many of the other strategies where you can quantify your risk.
And keep in mind that anytime you end up selling options, which you would on the short side, you've defined your profitability by the income that you've taken in by selling the option, strangle or straddle. And in the case of these two, as opposed to the long side, these two, with the short side, you're looking for no movement in the underlying. You want those options to expire worthless and keep the money, so to speak. On the long side, however, now you're looking for some action in the stock. The difference is you're not sure. The reason we're straddling the market, buying a call, buying a put, is because we're not sure what's going to take place in the underlying, but we have an idea that something is going to happen, whether it be an earnings report, whether it be a news item on the firm, but we're not sure how it will react. If the earnings are above expectations, clearly you'll get one reaction as opposed to one that even meets expectations or is lower than expectations.
Well, with the straddle, you're at the money, so you've clearly defined the strike. With the strangles, you're just out on the money, call and put. So, the two... I think the two real difficult issues, when it comes to options are, what strike, what month. We've taken care of the strike side of things. What about the month?
Well, this is the interesting part with these strategies, is because you're looking for volatility in the underlying, and by that I define at this point in time as by significant movement due to an event, news item, economics, whatever it may be, but you're looking at something that's going to come out, earnings or whatever. So your duration in this case is probably a little bit shorter, the months, in other words, getting into it. This is a really relatively short duration trade because you're looking for an event. Once the event occurs, you're going to be looking to make an exit on the trade or do something with it. So clearly getting into the trade, you don't need to get in very far in front of the event. And I'll touch on volatility as we talk about through here. I know, Joe has that as part of our questions, but you're looking to get in and then exit after the event occurs.
So why don't we focus on volatility? Because, we're talking about positions, we're long options, so we're obviously long vol. So you got yourself a vol play here with Straddles and Strangles.
Yeah, and I think the thing you have to keep in mind and really focus in on here in the volatility scenario is because you have a volatility play, you're long volatility, and as volatility increases, option premium increases, therefore the cost of entering the trade increases, which leads to you need a bigger movement in the underlying.
I mean, everybody knows earnings are coming.
Right.
So
that's the issue. As Joe said, everybody knows that the earnings are coming, so that volatility prior to the event will start to be moved into the option premium. Volatility will start to rise in that. The decision that you as an investor need to make it's again the timing. You're going to one of the research things you do. These trades do require some research. One, of course, is looking at volatility levels.
And how do you find something like that?
You can go on the websites your brokerage firm has them. The OIC websites have those. You can look at implied volatility levels. You can compare them from historical levels to where it's been. One of the ways I would do this that I did with these trades, looking at the underlying security in particular. We know that news is coming out of it. I'm going to look back to see at least the previous time that this type of news, for example, earnings came out, and how did it react to those earnings? And see, number one, I need to be confident that if the earnings came out last time and they were above expectations, that the stock had a significant move following that earnings announcement. That leads me then to the next level. If it meets one of those criteria, then I might go back and check, well, where were the volatility levels leading into this earnings announcement, compare them to what I'm seeing today. I would caution that say that if you look and see that the implied volatility levels have increased significantly over the last couple of days, let's say, as you look to get into the trade, that's still not a reason not to do the trade. It really goes back then to the underlying security, and does it have the firepower, if you will, to make a significant move? Now, that could be up or down. Remember, we're long a call, longer put, so we're not saying, we're looking for increased earnings. We're looking for an earnings report, but nobody's really sure where it's going to be. We think we can have a significant move no matter what it happens on that. So you have to be aware of that. Getting into the trade, you're looking out a week, 2 weeks, see how those volatilities. It takes research. I call it stubby pencil work that you have to do. You just can't say, okay, earnings are coming out. I'm going to buy the day before earnings come out. I'm going to put on a straddle on this. That may be the issue where the volatility is at its highest level that it's going to be. Therefore, the premiums are going to be a little bit elevated.
So you better to be lucky than good, huh?
Yeah, in that case, to a degree.
Let's see. You put this trade on, and I think maybe you've talked about this a little bit. The event happens and you're out. So these positions typically are not positions you put on and then wait to expiration. Is that your experience in trading them?
Absolutely. I would not be looking to take this to expiration. Now, that doesn't mean there are some exit strategies that you can look at.
Talk to me about a few of them.
And once again, let me preface the whole thing with you better have, or you should have, a trading plan no matter what. And we're not just talking about straddles and strangles. We're talking about whether you trade equities, options, or whatever. You need to have a trading plan, and you need to have, before you enter the trade, your exit points in mind. Where do I exit this trade? And by that, it's profitability, and it's also what happens if it doesn't work. Don't hang on and hope. I mean, here we are looking for an event, and if it occurs and we don't get the reaction that we're expecting out of the security, And it will probably move, but it won't move as significantly as we had hoped. We need to make that decision to pull the trigger, exit the trade, and look for a new trade.
And maybe in that case, take a loss.
And yeah, absolutely. And that may require taking a loss. One of the things that I kind of enjoy with Straddles and Strangles, and one of the challenges that come with the trade itself, is it's a psychologically challenging trade to do. And that comes in the fact, and just as an example, let's say we put our straddle on, the event comes along, and we do well. And we have a quick run-up. We've expected this. So if our trading plan's in place, then that's telling us that we should probably take the money and run, exit the trade. You could get caught up in, wow, I've done very well, this could continue. And we're talking on one side, call or put here. The other one, of course, is moving in the opposite direction. But we've done well. Overall, now we've got a profitable trade, and we'd like to keep it. We think, let's keep it on. Let's abandon our profit point because we think we've got something good going here. Then it becomes frustrating because sometimes you'll get pullbacks or rallies in stocks if the stock had gone down. Now you're watching what you had, a nice substantial profit early, start to erode. And you're becoming more frustrated with yourself.
That never happened to you?
No.
Me either.
It's always good to change your opinion rather than lose your money is one of my my axioms, I guess, for trading.
Right.
I think that one actually was my wife's idea. Don't be so stubborn, change your mind. But the point being that now the psychology has become you had a profit, you've let it, now it's come off a little bit because the stock has pulled back or rallied. And your ego takes over a little bit, and you want to try to massage it a little bit, keep the trade on longer, see if it'll come back, that type of thing. And odds are at that point in time, it's probably not going to get a lot better for you. It's probably going to get a little worse. So there's a psychological thing in there with it. Now, some of the other ways to exit the trade is exit the profitable position and keep the non-profitable position for exactly that reason. For you may get a rally or you may get a pullback, and the other side may react to it. May not get you back to even at the end of the day, but it may get some back premium. Trading plan. It all comes down to that. Your focus, your idea on how am I going to trade this? What am I going to do? What's my comfort level with it?
I'm going to pull one more of the Greeks into this, type of strategy, and that is delta. Now, let's say we got XYZ and we paid $5 for the straddle. Does delta come into play as that underlying moves away from the strike? And do you manage that, or do you just look at this position as a $5 investment and you're going to sell it for more, or talk to me?
Well, I think the issue is since you're long a call and long in put, what you've got is two deltas working in opposite directions. So if the stock continues, the underlying security continues to rise, you've got the call going into money and the put going out of the money. So you've got delta going in different directions. So in a broad sense, the delta is neutralized in this type of strategy. So you've got that. However, there is another Greek involved in this trade, and that's theta, or time decay.
Sure.
You're long two options. Whenever you're long an option, basically time decay is your enemy. Well, now it's twice the enemy here because you're long two options. That's why I say they are short duration trades that you're looking to do. You need, and that's an issue if you decide to keep the trade on beyond it, because you're not buying it, you're not buying the option 3 months out for this. You're buying a shorter term option. So time decay is going to be a major factor involving with it. And that's something more so than delta, I think, that you need to really manage and keep your eye on. And that has a lot of effect as it moves into the trade occurs, and if nothing happens, that's you're making a decision to get out of the trade and move on to the next trade. No trade works 100% of the time.
And back to the whole idea of volatility, volatility in theta, obviously the higher the implied volatility, the higher the theta is going to be, because the higher the implied, the greater the premiums.
Right.
So again, if you wouldn't mind, tell our listeners how they can find those implied volatility levels.
Those levels are all available. Again, the exchanges, more so the brokerage firms, and of course the Options Industry Council, the OIC website, optionseducation.org.
There you go.
You go on there and you can track down these figures and get them. No cost to you. They're there, and you can use them to analyze your trade and get things in position.
And so their chart's very much like an underlying chart. You see over the course of 6 to 12 months, the highs and lows of the historic and implied volatility, right?
Right, and you can extract from that. That'll give you a good picture too. Again, over time, particularly, does the stock, the underlying stock, ETF, whatever you're trading here for this event, does it have the past record and the firepower to make the move you need to make the trade profitable? You could look at it and, I'll just pull something out of the old thing, but if you're looking at doing this and you're looking at perhaps a utility stock, you might want to think about that and check and see what kind of move you're going to get. And it could be determinant on premium. If you can put it on for a reasonable premium at that point in time, because the volatility may not be as high in a utility stock as
sleepy old utility.
Yeah, let's say good old Google. There's something to be made. I never say there's no, how should I say it, no opportunity to take a look at a possible trade, going out there. It's just that you have to have a plan in place to eliminate the ones that have a lower probability of success. And you do your research. You've got to do the research. It isn't just, wow, it's Google, the earnings are coming out, I'm going to put on a straddle. You need to even on that one step back and look at what's happened in the past, get a consensus. You can go online and you can get consensus of the analysts. What do they think it's going to be? And get a picture of that.
Good advice. Well, anything, I think we've covered that straddle and strangle pretty thoroughly. Anything else you want to add?
Not really. I think, like you said, we've covered it real well. It's a challenging trade. They all require research. This isn't just for straddles and strangles. It's a good short duration trade. I think that fits in rather than some of the other ones that you may want to run out to expiration. They have their place in your portfolio too, income strategies and such. But I think that they are good. They have a psychological bent to them, more so than I think most trades, because of that quick run-up scenario that you might have, or in profitability, and you get caught up in that. Wow, I think I can squeeze out another dime out of this and stuff like that. As well as I do, doing that's not going to get you the dime. That'll be the high, and you'll never see it again.
So often the case. So, well, let's. How about if we wrap up? You've been around the block for a little while. Let's give our listeners a little something to chew on as we wrap it up.
How about a little story from what we used to do on the floor?
Talk to me.
That I can actually
I'm all
do
ears.
on the air.
Let's do
Joe
it.
knows as well as I do that there was a lot of activity that we carried out, or carried on, maybe is the better word for it, in the early days of a trading floor, which was a great environment. I really personally feel very privileged to have been part of a really strong trading floor environment. It was a lot of fun. It had its daily challenges on that, but it was an awful lot of fun to be down there. Made a lot of good friends that I still have, Joe, for example, and some others in the industry, and a lot of fun. But we had our moments, if you will, down on the trading floor. And now remember, you're talking about a large group of individuals that are pretty active all day. Doing it. And occasionally when we would have news media come down to the trading floor to film a segment for the evening news locally, particularly, in the Philadelphia area, they would come down. There was some economics going on, something going on in the market. They would show up at our door, and the local newscaster would be down there, usually a famous personality. And they would stand on the floor with their microphone, and their cameraman would be in front of them, and he would turn on his camera and start to film. And sure enough, just as he got going, right behind him from the trading crowd, one of the traders would walk across in view of the camera, wearing perhaps a gorilla mask or some sort of Halloween mask. You could see the cameraman just slump down. He would just say, "Stop, let's do it again." And on many occasions, we got to the point where the cameraman would actually just plead with us not to do that again, because he had no film left in the camera. He had one chance to make a take for it. Some of the
just another day on the trading floor. Al.
Some of the announcers got very frustrated with us, say, "You guys are all crazy down here," and we'd all nod in agreement. And it was a lot of fun, but we would do things like that. And then in the honest part of it, if they interviewed us or they were talking down there, we would let them get away with it. But they know they had to pay a price to be down there.
Indeed, they did. Well, Al, really appreciate both some of the stories, some of the history of your experiences, and then a nice in-depth discussion about straddles and strangles. So thanks so much for being here today.
Thank you very much. My pleasure.
Bye-bye.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
Our tools, resources, and good reads segment today will focus on candlestick charting techniques. Now, the first time I heard about candlesticks, which actually was a heck of a long time ago, I thought it was probably the latest gimmick in chart analysis. Once I tried it, though, I found the technique far more compelling than the standard bar chart. Now, the candlestick charts themselves, to me, really pop off the computer screen because of their colors and the makeup of the charts themselves. Candlestick charts are comprised of bodies and shadows. The body is the range of the opening and closing price. Okay, so the body's the range of the opening and closing price, and the shadows are the prices above and below the body. Underlyings closing above opening will have one color body, often green, and when the close is below the open, the body will have a different color, often red. As mentioned, this chart picture has a lot more life than the standard bar chart. Now, besides the chart itself, there are many, many candlestick formations that can signal expected bullish or bearish movement for the underlying. Doji and Hanging Man, are a couple of the names associated with candlestick formations. Getting to know the formations will take some commitment to really understanding this particular charting technique. Now, I've read that candlestick charting dates back to a rice trader in the 1700s. So there's a lot of history associated with this charting technique. If you wish to learn more about candlesticks, I suggest checking out one of Steve Nissen's books on the topic. I believe his first book on candlesticks dates back to 1991, and his most recent book on the topic is Strategies for Profiting with Candlestick Charts, released in 2000. That's it on candlesticks, and that's it for tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
Let's talk tech in today's Looking Back. The NASDAQ index has been around for a long time. It's a tech-heavy index. In the late 90s and early 2000s, the tech-heavy NASDAQ was on fire. For those of you who don't pay attention to market history or long-term charts, the NASDAQ index topped out at just over 5,000 in the year 2000. It crashed to about 1,200 in the recession of 01-02 and in the aftermath of the 9/11 attacks. We're approaching the mid-3,000 range now as we fight our way back to those exaggerated valuations of over a decade ago. Price-earning multiples were out of sight. Mornings on CNBC were madness, with pre-market indications for stocks frequently showing large gap openings to the upside. For you option players, it was a time when the cost of gamma was crazy high, but it always paid for itself with the wild swings in the market. That was the NASDAQ 10, 12 years ago. Please join us next time for OIC's Wide World of Options.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_EDU. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.